Welcome and good morning, everybody, today. I'm Mark Mazur, the Robert C. Posen Director of the Urban Brookings Tax Policy Center, and happy to welcome you here to today's event. The session today is focused on the relationship between wealth taxation, entrepreneurship, and philanthropy. And we have an all-star lineup today to go over these topics. First off, I'd like to acknowledge the online audience who's tuned in today and encourage all of you, both the online audience and the people here, to share your thoughts and observations using the hashtag #LiveAtUrban. And for online viewers, we encourage you to ask questions, share comments. Just email us at events@urban.org. And I want to thank the Ewing Marion Kaufman Foundation for supporting today's event and for supporting some of the body of research that will be presented, the work that is done by TPC staff presented later this morning by Rob McClellan. We're grateful to the Kaufman Foundation for their longstanding support of research and analysis at the Tax Policy Center. I want to take a moment just to introduce the folks we have with us today. Len Burman, my predecessor and current Institute Fellow here at the Urban Institute. He'll be leading a moderated discussion among the speakers this morning. But before that discussion, we'll have a series of short presentations. Rob McClellan, the Senior Fellow at Tax Policy Center, will start off today's presentations with an overview of some research that he and Len Burman have done on the effects of estate and inheritance taxes on entrepreneurship. Also joining us today is Sheena Ashley, Director of the Urban Institute Center on Nonprofits and Philanthropy and Vice President at the Urban Institute. We also have Gene Sterling, former Director of the Tax Policy Center and Institute Fellow at the Urban Institute, and former Treasury official and just about every possible job that could have been done in Washington. And then I'd like to introduce Jenny Bourne from Carleton College in Minnesota, where a snow emergency was declared on Monday. We did not declare a snow emergency here today with our puny 1/2 inch of snow, but I'm glad you're able to be with us today. We're going to get right into the formal program, but allow me to remind you again to share your thoughts using the hashtag #LiveAtUrban. And without further ado, let me turn things over to our first presenter, Rob McClellan.
Thank you, Mark. So I'm here to talk about the estate tax and inheritance taxes and how they might affect entrepreneurship. This is joint work, as Mark said, with Len Burman, also with Chenzi Liu. And let me get this working. Oh, there we go. Len and Chenzi and I conducted this research. And we looked at how the estate tax and inheritance taxes might affect entrepreneurship through two separate channels. First, we looked at how changes in wealth taxation or wealth transfer taxation might affect the likelihood of self-employment for people who are near retirement age. So they might be looking to retire, continuing work. How does the prospect of leaving a taxable estate affect that decision? And in our second channel, we examined how the receipt of an inheritance might affect the probability or propensity to own and manage one's own business. There we go. So entrepreneurship involves innovation or risk-taking or some characteristics like that are unfortunately extremely difficult to measure. And so as a caveat, I want to say that when we look at things like, when we look at business owners or the self-employed, it's not clear if we're looking at entrepreneurial self-employed, entrepreneurial business owners versus all business owners. So the effects that I'm going to talk about hold over all business owners and presumably entrepreneurs, but we can't specify just those who are especially innovative and creative. And another caveat I wanted to mention is that when we look at receiving an inheritance, it's difficult to disentangle those who receive an inheritance and then go on to run a business versus those who have parents who owned a business, who taught their children how to run a business, gave them the business acumen, and also gave them an inheritance. We can't separate those two because we don't know if the parents owned a business or not. So with those caveats in mind, just wanted to talk briefly about what it means to be an entrepreneur. There we go. The one classic definition by Schumpeter is it's an innovator who brings together existing productive resources in new ways or for new purposes. So again, getting at the innovation aspect of this. And as I've already clued you in, we don't have data that lets us look at what it means to be particularly innovative or less innovative. We can't look at how taxes, a higher tax rate, makes people more or less innovative. And so, as in much previous research, we're going to use self-employment and owning and managing a business as definitions or stand-ins for self-employment. So I want to look briefly at the estate tax for just one moment. And over the last several decades, we can see that the top tax rate for the estate tax has been falling gradually. In 2010, the estate tax was temporarily omitted or disappeared. It reappeared. The rate went up to about 40% where it stands today. The exemption amount, the amount of wealth that can be transferred that's exempt from taxation, has grown more or less continuously. In 2010, again, the estate tax temporarily disappeared. It reappeared. The exemption level continued to rise slowly, and then most recently, in 2018, the exemption level effectively doubled. Now, as a consequence of that, less than 1/10% of decedents are expected to be subject to the federal estate tax. And TPC estimates that fewer than 4,000 estate tax returns will be filed in 2018. And in addition to that, in addition to the fact that there's very few of them, there are ways to reduce the amount of state taxes that are paid. One can leave charitable bequests, for example. We're going to hear about that later. And there are also special provisions for small family-owned businesses, small businesses, and so on, through such mechanisms or provisions as valuation discounts. So overall, it's a small number of people, and there are ways to reduce the amount of the estate tax. That said, I want to briefly talk about this first channel or venue where we see the effect of the estate tax on self-employment. So entrepreneurs face two opposing forces from the estate tax that might affect whether they continue to stay in the labor force or not. On the one hand, if an entrepreneur is looking to leave the largest possible estate to his or her heirs, and they're also deciding whether they would like to have more leisure, maybe they'd like to retire, an increase in the estate tax would reduce the benefit or reduce the rewards from further work. That is, they could work more, but some of that is going to get siphoned off to the federal government in the estate tax, and so someone who's just indifferent might get tipped towards retiring. So an increase in the estate tax might reduce people's willingness to continue to be self-employed. It might induce them to retire. But on the other hand, if a entrepreneur wanted to leave a specifically sized estate or endowment to their heir, suppose they wanted to leave $20 million to their heir, an increase in the estate tax might actually lead them to work harder. Now, because the estate tax is taking more away, they'll have to work harder, longer, more years in order to hit that $20 million target. Now, both of these are, there's two different things and two different effects, and they oppose each other, but both of them rely on a bequest motive. Absent a bequest motive, it's not clear if people would respond at all. And research on the bequest motive is actually surprisingly mixed. There's good evidence that most bequests are accidental. That is, people leave a bequest simply because they die before they run out of money. On the other hand, inter vivos giving during life, tends to be compensatory. So we see a parent with just 2 or more children. They're advancing in their lives at different rates. Some are doing better, some are doing worse. And there tend to be gifts towards those who are doing worse. They tend to get more money. That certainly speaks towards something like a bequest motive, about caring for the children. Yet when people have looked at bequests per se, they tend to be equal. They don't tend to be compensatory. It tends to be just an even division. So that suggests there isn't much of a bequest motive. Finally, a good share of people who pass away don't leave a will at all, which says that if they care about bequests, they certainly would leave a will, or leave some way of determining what their wishes. If we look at entrepreneurs, business owners, the wealthy in particular, the story is a little different. There's evidence that business owners are more likely to purchase life insurance, which suggests that they're taking measures to safeguard their business that can be passed on to their heirs. And there's also evidence that the wealthy are more likely to have a bequest motive. And of course, the wealthy are the ones that pay the estate tax. So perhaps they are being affected. Perhaps even if most people don't have a bequest motive, if the wealthy tend to, and they pay the estate tax, it still might have an effect. But on the other hand, there's also evidence that people who are likely to be affected by the estate tax don't do everything possible to reduce the estate tax burden. For example, they could do more inter vivos giving. They could give more to their children during life. And so overall, it's not entirely clear from prior research if people are affected by the estate tax or not. We're going to look at this, as I said, in two channels. And in our first channel, we look at the self-employment status of those who are those who are near retirement. We look at we use the health and retirement study. This is a longitudinal study of those who are 50 years of age and older. We follow them over time as they age, they make life decisions, they retire, they continue to work, and so on. Every few years, a new wave of 50 years old and older are brought in, so the sample is refreshed. And we're going to look at how their willingness to be self-employed is affected by leaving a taxable estate, that is, facing a possible estate tax burden. And we looked at this in two different margins. We looked at the decision to be self-employed versus working at a salaried and wage job. And the results here are this gray bar, which is actually kind of hard to see for most of these. And the reason is because it's extremely small. There's apparently almost no effect at all of the estate tax on a decision to work as self-employed or work for a wage and salary employment. Now, I should have said here, we cut this in a number of different ways. We look at everybody. We look at those who are married, those who are single, those who have children, and those who don't, with the idea that some of these will be more strongly affected by the estate tax than others. So the self-employment versus wage employment decision, there doesn't seem to be any effect. But if we broaden that, self-employment versus all possible alternatives, such as retiring, exiting the labor force, taking a trip around the world, we do see an effect. Overall, the effect is that an extra $1 million in taxable estate seems to reduce the probability of being self-employed by about 8%. It's 7.3% for the married, 7.8% for those who have children, but there does seem to be an effect. These red lines here are confidence intervals. They're like margins of errors and polls. And they indicate that those who have married and those who have children, the results are statistically significant. That is, we can reject the hypothesis that there's no effect at all. But those who are single, those who have no children, the results are insignificant. Yeah, there's a blue bar there, but it's insignificantly different from zero. There's no evidence that there's any effect at all, which is exactly what you'd expect if we are, in fact, seeing people who have a bequest motive. Moving on to our second channel, we look at how business formation is affected by inheritance. And just as with this entrepreneurs, there are two opposing effects here. One is the Carnegie conjecture, the idea that if people are given a large inheritance, they're less willing to work. And the idea here is people decide to work. Well, they work because they need to consume. They need to eat food, they need to have clothes, they need shelter. And so this labor-leisure trade-off that people make, whether to work or not, is really a leisure consumption trade-off. They can relax or they can consume, but it's hard to do both unless you receive a really large inheritance. And then you can do both. And there's evidence that people, in fact, are doing exactly that. If they receive a really large inheritance, they tend to retire early, they tend to exit the labor force, they report fewer labor hours. But on the other hand, there's another force. Liquidity constraints are certainly an important factor in starting a new business. And so inheritances can be used as seed money for those new businesses. So you would expect that a large inheritance would help people start new businesses. And there is at least some evidence that's the case. So to test that, we looked at the Survey Consumer Finances, a data set that has a rich information on income and assets. So we know a lot about people's income. We know a lot about the assets they hold. We know if they own a business or not. And we know if they actively manage that business or not. And we're going to look at how the propensity to own and manage a business is affected by the mere fact of receiving an inheritance and then the size of that inheritance. And we have a number of different models here from left to right in terms of complexity. On the extreme right, we see our most complex, most sophisticated model. And we find that simply receiving an inheritance raises the probability of owning and managing a business by 13 percentage points. And the little confidence interval thingy there is really tiny. It's very precisely measured. There's a very obvious effect. In addition, we find that an additional $1 million of inheritance seems to increase the probability of owning and managing a business by about 1 percentage points. That's a less precisely measured effect, but still, it seems that it does make a difference. And those are our results. We've looked at two different channels by which inheritance or estate tax can affect people's entrepreneurial spirit, by affect their willingness to be self-employed. The estate tax, an imminent estate tax or looming estate tax, does seem to affect people's willingness to be self-employed, but not in a choice between self-employment and wage employment. It's self-employment versus leaving. And since these are retirement age people, we presume most of them are retiring. In addition, people who receive inheritances do seem, in fact, to be much more likely to be entrepreneurs. Now, keep the caveats that I've mentioned in mind, and also keep in mind that the estate tax only applies to a very small number of people. And so it only would apply to a small number of entrepreneurs. And that's it. Thank you.
Thanks for including me. I do especially appreciate the snow. As I was coming in last night, I felt truly welcome. The marvelous thing about working with statistics of income at the IRS on estates is that you get to talk about both taxes and death. And what's even better is when Thomas Piketty makes your data set instantly relevant. As you probably know, Piketty and his co-authors suggest that because the return to capital has exceeded the rate of economic growth in recent years, wealth is becoming more concentrated. But that's not all. As F. Scott Fitzgerald reminds us, the truly wealthy differ from you and me, in part because they tend to hold portfolios that enjoy higher economic returns. They can take a longer view when it comes to finance. At the same time, the rich realize lower returns because they have the luxury of timing. And selection bias means that ex post measures of who is wealthy include those better than their peers at making just the right investment. So inferring wealth concentration from realized capital income may not tell us just how unequal we really are. By the same token, relying on realized income can overstate progressivity in the tax system. So having reliable wealth data for rich people would be truly useful, and SOI has it. As an aside and a foreshadowing, the effective federal tax rate on income from capital among the very wealthy is something less than 10%. And taxes paid during life as a percentage of wealth are less than 3%, with the richest paying the smallest fraction. I'll come back to this. So, very brief theory. People make intertemporal choices in an uncertain world. Most important for us, higher income people face higher statutory marginal tax rates, so they have a greater incentive to seek tax-preferred income and to avoid realization, and they have the means to do so. The data that I use consists of people who died in 2007 who filed the estate tax return form 706. I link these individuals to their federal income tax records, form 1040 for 2002 to 2006. And this slide shows that the mean estate was about $6 million and the median about half that. My measure of wealth is gross estate plus valuation discounts that Rob mentioned, minus debts and mortgages, what we call net estate. In thinking about taxes paid during life, we'd like to know about the overall population, not just decedents, because naturally those who die are older on average than those who live. So the good people at SOI created multipliers using national mortality rates by age and sex for holders of large annuity policies so that I can gross up the decedent population to reflect the living population who had at least $2 million in 2007. Now let's go back to the dead. By number, the largest category of net estate was $2 to $5 million. As Rob alluded to, and you can see, the numbers of estates paying taxes will fall sharply under the recently passed Tax Cuts and Jobs Act. For the very rich, stock comprised nearly half of their assets. Personal residence accounted for smaller and smaller portions at higher wealth levels. And you'll see why this is important later. This is a lot to absorb, but I'll walk through it. From the Form 1040, I constructed two measures of capital income. These are in constant 2007 dollars, chain GDP deflators averaged over the 5 years before death. One measure is without regard to tax treatment. So we had to make some decisions. Income from Schedule C, E, and F arguably flows from both capital and labor, so we don't want to include the full amount. Schedule C and Schedule F amounts are relatively small. Schedule E income is a hodgepodge, mostly labor income for lawyers and accountants, mostly capital income for those with passive partnership income, rents, and estate and trust income. So to keep the realized measure high, I call 75% of Schedule E income capital income. IRA distributions and pensions and annuities also include income from capital, but as well, they include a return of previously untaxed labor income. So we include a portion of that type of income as well. The second measure, net taxable capital income, converts capital gains income to an amount equivalent to what it would have been had it been taxed at the same rate as income. So for those with net estate greater than $100 million, yeah, there were people, yeah, capital income constitutes more than 90% of total income. The lowest category of wealth has a smaller percentage, but it's still hefty at just over 65%. This slide is really important for what's not there. You can see the columns don't add up to 100%. In fact, what they show is that 1/5 to 1/3 of capital income realized by wealthy decedents bore no federal income tax. This slide shows that decedents with assets of at least $2 million realized less than 4% return on their wealth, and the taxable return was even lower. The graph highlights the decline in taxable realized returns to capital at the far right tail, and that fall is more acute when we look just at non-homeowners. That makes sense. Implicit rent received by homeowners is not included in capital income. So realized return to capital is biased downward relative to economic return, even more for homeowners. And as we saw earlier, the value of homes generally was a larger proportion of net estate at lower levels of wealth. Now, this is a busy figure, but what it attempts to show is the distribution of returns both for the decedent and the living population. And you can see three things. Across all wealth groups, a significant majority reported a taxable return to capital of 0 to 2%. Realized returns for the living population tended to be even lower than for decedents of the same wealth class. This may reflect a greater ability to consume out of wages for the young and a greater need to realize income to pay medical bills for the old. And strikingly, the very richest had the largest fraction reporting returns of less than 1%. Keep these figures in mind. Here we can see that the realized return for the living population is greatest for those in their 60s. Oh, that resonates with me. Perhaps reflecting pre-retirement diversification of assets such as sales of small business holdings. We also performed regression using a log-log form so that we could interpret the coefficients as elasticities. So we did log of capital income and also taxable capital income as a function of most important variable log net estate, age and age squared, demographic dummies. We included log charitable contributions. This variable reflects the fact that you might realize more when you plan to make a larger contribution, which is deductible. And the percent of estate represented by the value of one's home. That's an attempt to get at the implicit rent question. The key finding was that realized capital income was inelastic with respect to wealth. Realized taxable income even more so. And this despite the expectation that true economic income from capital should be probably elastic with respect to wealth. These results suggest that wealth is more unequally distributed at the top than is realized capital income. It also seems fairly clear that much economic income of top wealth holders is not subject to federal income taxation during life, or it receives a preferential rate. Several researchers suggest that long-term real yields on stock are at least 7%, but the typical realized return on capital by a wealthy person in our data was 2%. This translates to an effective marginal federal tax rate of around 10%. But the rich also pay other sorts of taxes. So looking at the effective federal tax rate doesn't give us a full picture of the tax burden on the wealthy. My work in progress focuses on the living population of single itemizers who had at least $2 million of wealth in 2007. The living population is more relevant for thinking about taxes paid during life. Itemizers are the only ones that I could obtain information for on state and local taxes. Single people means that I could easily calculate Social Security, Medicare taxes. I could sidestep the issue of allocating capital income across spouses, and I could avoid dealing with possible strategic behavior designed to inflate the marital deduction on the estate tax. And these constraints leave me with about 1/3 of the original sample. I changed the wealth category slightly for this analysis to obtain finer information at the bottom and avoid small cell sizes at the top. So just in summary then, taxes paid during life constitute less than 3% of wealth for the rich. The percentage is lowest for the wealthiest individuals. The federal income tax constitutes about half of total taxes paid during life. Here, just note a couple of things. The most important taxes paid during life, other than the federal income tax, are state and local income taxes and arguably imputed corporate tax. State and local income taxes come to less than 0.4% of wealth for all wealth categories. The jagged shape likely has to do with differences across state in wealth distribution and in AGI wealth correlation. New York, for example, has a disproportionate number in the $10 to $50 million category. New York is a high tax state, and it also has a strong correlation between AGI and wealth for its residents. If I use the Treasury assumption to allocate 82
differ from others, not just simply because they're wealthy, that's tautological, but the ways that they got to be wealthier. So they've likely, more like, doesn't mean that every case it's true, but they're more likely to have had a higher rate of return on their assets through luck or skill or entrepreneurship. They're more likely to be savers. If you and I start off in equal positions, I save and you don't, at the end of my life, I'm much more likely to end up with a substantial amount of wealth than are you. And of course, wealthy also are very likely to have inherited some of their wealth, financial, real, or human capital from their parents. But that doesn't mitigate the fact that even among that group, the people who save more or get a higher return are more likely to fall into this wealthy class. So there's a very selection issue when we examine the wealthy individuals. So here's the pattern. The first thing we examine is the extent to which people give nothing. So this is the number of people who give nothing on their individual income tax returns. And it's actually a very, very small percent. Now this percentage here, which is typically less than about 20-25%, except at the bottom, is a percent who either give nothing or do not itemize. So we don't know the amount of giving of the non-itemizers. When we take into account the non-itemizers, who in the lower classes might be 20%, in the upper classes very, very, very small percent, we actually conclude that probably close to 90% of people probably give something on their individual report giving, do give something on their during life or during their last years of life. When we turn to the estate, however, and we ask the extent to which they give, we find that the vast majority of people don't give. Now you might say that some of this has to do with the fact that they've decided they're not going to give while their spouse is still alive, so we separate the married, which are the blue bar, from the single returns, and we find that that still the majority of people, except in the very top wealth classes, do not give out of their estate. Even in the $10 to $50 million classification, the single filers do not give. The majority, 55% of them, don't give. Only single filers in the 50 million and above classes actually do the majority give more, actually give anything out of their estate than in all the other classes. So this might ask the question, well, do we find patterns of giving at least consistent? And to some extent, there is a correlation. If we find a high rate of giving during life out of their income, we find a higher rate of giving out of estate at death. However, what we don't find is that the pattern is all that consistent. There's a huge, huge amount of variation. So this slide, the bottom of the row is the average share of estate given to charity. So we go all the way from giving nothing out of your estate to charity up to 20%. We still find, even for the states that give 20% of their estate to charity, up to 25% of them basically are not reported as giving anything on their income tax return. Again, that means either A, they didn't give anything as an itemizer, or B, they gave less than the standard deduction in the case of some lower wealth classes. When we turn to flip this and we ask, well, let's see if people who give a lot out of their income during life, that's the bottom row classifier. So we look at, for instance, 20% of people who give 20% of their income to charity. We still find that the majority of them, the majority of people who are giving 20% of their income to charity, still give nothing in their estate. So there's a great deal of variation and inconsistency in giving patterns that we find. However, if we try to compare total giving at death to total giving during life, we find that it's a huge multiple. That is, the estate giving ends up to be much, much larger in total than does the giving out of income during life. So whether we take young men, young women, older men, older women, we find consistently that the total giving out of the estate by those few who do give out of their estate will dominate the giving in the last 5 years of life by the same people when they were before they died. And then when we look at the multipliers, only in the under $2 million class, which is a class of people who actually don't pay estate tax, do we find that total giving out of the estate is less than total giving in that last 5 years of life. Once we get even to the $2 to $5 million classification, that's the first class for this year that actually had to pay estate tax, they find that their total estate giving is about 4 times their giving in their last 5 years of life. And when we go all the way up to the $100 million and above wealth class, we find that they give 20 times as much out of their estates as they do in the last 5 years of life on their income tax returns. Another way of looking at this slide is to look back and say, well, let's look at the charitable giving during life, and let's measure it as a share of their wealth, assuming that the wealth we have in this last year, 2007, is approximate of the wealth that they had in those last years of life. And what you can see from this slide is that, generally speaking, people are giving away less than 0.5% of their wealth. Now, mind you, in the example I gave earlier in the discussion, that still might be 10 or 20% of their realized income. But at the same time, it's only about 0.5% of their wealth. And for wealthy people, in fact, even moderately wealthy people who have homes and corporate stock and other things, they're realizing, as Jenny said, they're likely to be realizing 5 or 6 or 7% returns annually in capital income, or not just realizing, but their economic income would be that high, and yet they're giving a very, very tiny portion, much less portion of their economic income. So how can we reconcile this behavior? Well, one is, again, going back to Jenny's slide. This is her more complex slide as she stated it. But basically, most wealthy people realize income of less than 2%, and the very wealthy, huge portion, perhaps 30%, 35%, you actually recognize less than 1%. So people don't realize a lot of their economic income. So if I'm thinking of giving 10% of my income, but I'm only counting my realized income, then I would be giving a lot less than if I gave 10% of my economic income. The complication, even with that, however, is even if we would multiply up this giving during life by 2 or 3 to say, well, what happens if their economic income is 2 or 3 times their realized income? Even if I multiply it up, it still would not mitigate the fact that the estate giving would still dominate the giving during those last years of life. So it's a partial explanation, but not an entire one. So another explanation is people say, well, people hang on to their wealth because they fear the risk of old age, such as high medical cost. And that's true, but it's not really a great explanation for the wealthy. They could easily insure against those types of risk. It doesn't seem to be true for someone worth more than $100 million that they're really fearing having to go to the nursing home for a couple of years. One that I think actually is very important that Rob gets into his paper, he didn't discuss it much in his discussion, is a lot of people just don't plan. A lot of people die intestate. You know, in fact, when I go to audiences, I would guess if I took a poll in this audience, I would find probably at least half of you haven't updated your will in 5 or 10 years, even though your wealth has probably changed significantly over that period of time. So there's something about planning at death that deters people from actually engaging in it. And also people like managing and investing their wealth. So that's an explanation why people don't give during their life. I would think that's especially true of entrepreneurs if they're not selling their assets. They like managing their wealth. Now, Warren Buffett has given away a fair amount during life, but he hasn't given it all away, although he claims to, because he likes managing it. He's not worried about consuming out of his wealth, but he likes and enjoys managing the wealth, and that's the activity in which he's engaged. However, I think that through all this, there is actually a much simpler explanation, which is basically that people, for the most part, just don't think that much about giving out of their wealth. I said this at the beginning for a whole variety of reasons. I don't think culturally that most of our giving appeals are on that basis. I think most of us think about what we're going to do with our income and what we can consume, how we can live off our income. We don't actually think about the possibilities that wealth gives us to be able to contribute. And as I say, this is extremely important for something like the Giving Pledge. Does something like a Giving Pledge actually ask people to start thinking about giving in a very different way, to be able to start thinking about what the possibilities their wealth offers them, as opposed to asking them just to give out of their income. And I think these data actually provide substantial evidence along those lines. So I think before us there's actually a wealth of opportunity, possibly, to increase charitable giving. The data don't prove it, but I think if you look closely at the data, you might come to a very similar conclusion that I do, that, that we can indeed increase giving if we could figure out ways to formulate appeals to people to give out of their wealth. Thank you.
Good morning. So I'm going to give you a quick break from SOI data. And we're just going to have, I know, I love it too, but I don't have it this morning. And what I'm going to do, thanks to the generous research support of Choice Ovalle in the back, provide some observations on the connection between entrepreneurship and philanthropy, just sort of looking at what we know from the literature and where I think some interesting new points of intersection in the research can go from here. So this is a topic that has gained some increased research, mostly through the generosity of the Kauffman Foundation, and in particular, the good, fortunate insight of folks like John Tyler and Robert Strom there at the foundation, who created really a research agenda at the foundation to look at this question around whether or not we know something unique about the philanthropic activity of entrepreneurs. Short question, the answer to that is no, not really. But we found some interesting things in the process of understanding that. Kind of what we think about when we think historically about philanthropy is tied a lot to entrepreneurs. And a lot of the behavior that people like me have who study philanthropy and the theory of philanthropy is based a lot on the experiences and the priorities of entrepreneurs. We see Carnegie in his Gospel of Wealth defining how people should be philanthropic, and we also have a lot of other perspectives around the way you should engage out of your wealth to partake in the delivery of social goods, and that's mainly been around people who've been able to earn that wealth through entrepreneurship. But I think that we have some ways to still go in our understanding of philanthropy. And just to be clear, I'm making a big distinction in this discussion between charity and philanthropy. Philanthropy is really a much more systematic and strategic way of thinking about the allocation of that wealth for social good and not just giving of income. So although we've made some progress in research and we've been looking at the connection between these entrepreneurs and their philanthropy, I still think there are two big limitations in what we've been able to understand. And it's mostly because what we understand is through this sort of myth of the great wealth creator who now turns great wealth distributor. And we understand philanthropy so much through what they've said about how philanthropy works. And so that's given us great insight into philanthropy, but it's also limited to their perspective on how you're supposed to give. And the other limitation is that we look at particularly their philanthropy at the end of the cycle. Everyone keeps talking about Warren Buffett and his giving sort of at the end of his sort of term as a wealth creator. But we haven't looked at their philanthropy throughout that philanthropic life cycle. What was Warren Buffett doing when he was 25 and earning the wealth that he's now giving away? What was he doing at lower levels of wealth? And so I think we have opportunities to understand the connection between entrepreneurship and philanthropy if we look more broadly and also take a more inclusive look at what we mean by an entrepreneur. And the good thing, to me, the opportunity that we have is that the way people are starting to understand entrepreneurship and look at who is defined both as an entrepreneur and who's been defined both as a philanthropist is shifting. And it's becoming much more democratic and inclusive. And so if we take that lens and look at it, we might have some more new insights that we can have. So I'm just going to look quickly at what we know in the literature of so far about what differentiates the practices of the entrepreneur from the larger world of the wealthy. Are they any different from just a regular wealthy person? And then think about some of the new trends that we're seeing in entrepreneurship literature and think about the implications those might have as we continue to think about a new research agenda, a more inclusive research agenda around philanthropy. So first, let me step back and talk about some of the general antecedents of philanthropy. There's about a list of 120 things that define whether or not you give and how much you give, but this is the short list and sort of the high points around what defines people's propensity to give. We know that demographics shapes a lot about whether or not you're philanthropic during life and death. And we also know there are some psychological implications on that, right? It's driven a lot by the ego, but we like to think that some altruism has something to do with that, and not just the monetary aspect, which is tax avoidance, which is why I give. But we also know from the literature that there are some things that are specific around entrepreneurs in terms of their giving. And what we do is we get some insight around that from research on the difference between inherited wealth and non-inherited wealth. And so we're starting to see differences in some of the work that shows that folks with non-inherited wealth have a substantially positive effect on charitable giving. They're much more likely to give throughout the life cycle, and when they do give, they give more. So the people who've inherited that wealth, like Rob said, are enjoying it on vacation. They're not giving through that. I mean, when you earn that, you're more likely to see that you have a social responsibility to give back to social good. And sort of building on the psychological factors, there is some research that also shows different psychological motivations for those who are entrepreneurs and their ability to give, right? So there are 3 factors that have been hypothesized to be connected to specific to entrepreneurs and their willingness to give. Generativity, which is around the motivation to benefit future generations. There's a different, and they're all kind of related. Immortality striving is around making a contribution that extends beyond your death. You really want to be able to see that legacy extend further. And then finally, legacy, the creation of a coherent end to one's life story. And we see that being particularly unique to entrepreneurs who feel like they have been creating and writing their story through their businesses, and they want to make sure that there is some record of that story, some legacy. And so they are much more likely to name buildings through their philanthropy, and also to create foundations through their philanthropy because of that legacy enhancing mobility that comes from those particular vehicles of philanthropy. So now I'll switch to the second question, which is sort of implications of the changing. If we are to pursue a more inclusive look at the relationship between entrepreneurship and philanthropy, what might we find? What are some things that we might look at? And pulling from the Kaufman 2017 report on changes in entrepreneurship, there were 3 major trends that stood out to me that seemed to be important around big shifts happening in entrepreneurship. And some of these are the same shifts that are happening in philanthropy, so I'm very fascinated by them. First, we see a shift in new demographics of entrepreneurship. And then there's a new map of entrepreneurship. The geography of where entrepreneurs are living and where they're starting businesses is changing. And then finally, there's sort of a new nature of entrepreneurship. The way, because of the way business works now and the way that innovation is working, is changing the kinds of businesses we're starting and the way that we pursue and generate wealth through those businesses. And so first, looking at demographics, the one thing we can observe in the trends on entrepreneurship is that the patterns in terms of who is an entrepreneur these days has not kept pace with the changes in the demographics at this point. We still have entrepreneurship being dominated by white males, but there are some signs of change on the horizon. We do see in statistics, recent statistics, that if you look more toward 2016, that we're having a growing representation of minorities as reported as entrepreneurs. And that change, to me, has important implications for how we might understand their philanthropy. If you look at this chart that's looking at the difference between how minority populations and white populations give, we see a particular difference in the propensity to give out of wealth, right? So whereas Jean was talking about we're not seeing folks giving out of wealth, that's particularly a white phenomenon. And when we look at minorities, we see a greater propensity to do that. Now, white people, this is not suggesting that they are less generous than other folks. White people do give a lot more out of income, but it does show us the differences in mechanisms that we might need to be looking at if we're trying to understand differences in their giving. And so as entrepreneurs become more people of color, We may not need to look at sort of their income-based giving as signs for whether or not they're philanthropic, but more of their wealth-based giving. Looking at that different map of entrepreneurship, we see that the places where entrepreneurs are living and people are creating businesses is shifting across the U.S. So there's still a bias a bit toward the coasts, but we are getting more representation in the Midwest area and starting to see businesses thrive in different places. And there's a great book that has been documenting this shift and the importance of this geographic shift across the U.S. and its implications on philanthropy. What we're starting to find is that even in place, even in state, the entrepreneurs moving away from this office park phenomenon. Think the garage in some suburban community where some computer technology was created, and it's now moving toward downtowns, so that we're now getting entrepreneurs who have great proximity to the social issues and concerns of communities. And so that proximity, I think, will have a difference in the way that they see their responsibility toward being philanthropic earlier in life, that as they're building their businesses, they're also going to be thinking about how those businesses contribute to the communities that they're now embedded in. And we'll also start to see, because of the geographic shift, changes in how people are giving. We already observe in the data that there are regional differences in the sort of the preferences for giving. We know that folks in the Northeast like giving to higher education. In the Midwest, there's hospitals. Out in the West, there's a lot more focus on the environment. And in the South, a lot more religious giving. And so as entrepreneurs move into those areas, will we continue to see these same patterns of giving? Or will they start to shift? And finally, we want to look at that new nature of giving, right? So one of the big things that we see shifting in terms of entrepreneurship is job creation. Because of the ability to realize massive scale and revenue with smaller number of employees, we don't have businesses that are being started with a lot of employees. And that has some implications for giving. Traditionally, entrepreneurs would say, we don't give a lot as we're building the business because we're creating jobs. So we're benefiting the community by creating employment. And when that is no longer the case, will they start to give more as they're building the business because they're not creating as many jobs? Is an interesting point to look at. And also, let's look at the nature of the entrepreneur. The kinds of entrepreneurship we have right now isn't just the business owner who wants to run that and burn himself out. We have these independent entrepreneurs, people who want to do enough hustle to make enough income for themselves, build some wealth, and then pass that on. And they want leisure time as they are building their businesses. And so what are they doing in that leisure time? They're creating more space to be engaged philanthropically by creating social change, doing ecotourism, and a lot of other activities that we're observing in young independent entrepreneurs. Well, that already is starting to have an effect as we see generationally in the way that different groups give. This is a research that's coming out of the U.S. Trust Bank of America study, and they are looking at different generations and their interest in either giving financially or considering their social entrepreneurship as a way of giving. And we see a much higher participation among millennials in seeing social entrepreneurship, the ability to create jobs, make wealth, grow a business, and have a social purpose around that as a way of being philanthropic. And so they might actually decrease their amount of charitable giving or what we might observe in their SOI because they're doing this through their business creation. So these are some interesting new dynamics that I think really are starting to give us some interesting taste if we can start to think a little bit more. It's not a plug to Kauffman to do broader research agenda around it, but I hope these observations have piqued your interest in terms of thinking about beyond the Carnegies, Fords, and Kauffmans of the world in terms of entrepreneurs to really the small businesses and the people who are creating the new generation of entrepreneur that we're observing. Thank you.
The estate tax can have effects on entrepreneurship. I guess not. We okay. Okay, good. Thanks. The estate tax can affect entrepreneurship. We don't just tax wealth and entrepreneurs via the estate tax, but also try to do it by the income tax, although not very well, as Jenny showed. Income and estate taxes can affect charitable giving, but it's not actually what economists or financial planners would work out on their optimization spreadsheets. And entrepreneurs are responsible for a lot of new philanthropy. And so that's why I brought these people together. But the real reason I brought them together is because I love the excuse of getting these 4 people together on a program, and I think they were great. If you're watching online and you would like to send in questions, I want to remind you, you can send an email to events@urban.org. And if you want to tweet, you can use hashtag #live@urban. Although given the focus on the estate tax, maybe try hashtag #dead@urban. Okay. My kids call those dad jokes, which is why I made them leave the house. Okay. So, Sheena, do we know if entrepreneurs are more or less inclined to philanthropy than other rich, successful people, hedge fund managers, entertainers, athletes, other super rich people?
So not really, right? So a lot of what I showed were some hypotheses and some psychological theories around the distinctions that they have, but a lot of those haven't been tested. And from an empirical measurement, we run into some of the same limitations that Rob ran into in his research, is that we can look at people who own businesses and think about and see if those are entrepreneurs. Or when we have wealthy, we have this distinction between inherited and non-inherited, but we don't know if that non-inherited is the hedge fund or the guy who created his own. So there is some conflation there of these different groups. What we can look at anecdotally is the list, the annual list of the wealthiest individuals and their philanthropy, which the Chronicle of Philanthropy publishes every year. And that list provides a good mix of athletes and entrepreneurs, and we know the professions of those folks. In observing that kind of list, there is no distinction in the levels and the participation of their gifts. There are differences that we observe, again, in where they give and what they like to do. And the entrepreneurs from that list is where we get the evidence that they like to have named gifts more than others. So we know there's a little more ego for the entrepreneur than the other rich folk, but not more than that.
We are very grateful for all of those entrepreneurs who are giving. And by the way, the Urban Institute's 50th anniversary is coming up, and a $50 million gift to the Urban Institute would be a great thing.
Put your name on it.
Your name, yeah. It's completely off script there.
I know.
There's a lot of concern about the new tax bill and its effect on charity. It's vastly reduced the number of people who itemize deductions by raising standard deduction and cutting deductions for state and local taxes. And also it cut the estate tax. It doubled the thresholds for the estate tax, as Rob pointed out. So only less than 0.1% of decedents are now subject to it. So even if the estate tax is affecting people's philanthropic decisions, it's not affecting very many people's. On the other hand, Gene and I think others on the panel have pointed out that people aren't really optimizing. The wealthy people are giving much less during life, which is the optimal strategy for avoiding tax than you would expect, and they're not giving that much, and a lot of them aren't giving on their estates either. Is that maybe good news, that if they're not optimizing, maybe the negative effects of raising the estate tax exemption and cutting the number of people who are itemizers would have less effect than we expect?
I think just the opposite. I think one thing we're very bad at doing as social scientists or economists is actually detecting the power of signals. So even when we run standard models for measuring the responsiveness of people to charitable incentives, we do things over sort of a very short period of time where we measure the marginal difference between your income being 50,000 and mine being 60,000. Are you paying a tax rate of 20% and I'm paying a tax rate of 18%? We go through all sorts of elaborate models. But what we don't estimate well, this is not just true in the charitable areas, a lot of areas, is the power of signals in society. And when you put out a signal that the income tax deduction is only available to now about 11% of households, tax units defined as households, you're basically sending out a signal that government doesn't really think a lot about this. And even the estate tax, which actually reflects on what you were talking about, Sheena, in the last comment, is for a lot of people, the significant gift comes very much because events, it's very event focused. For the entrepreneur, for instance, it's often they've actually stepped down from running their business. That's a major time at which fundraising appeals are made, like in the community foundation I'm involved in or other charities, is you catch that person at that time. And the estate is one of those times. Okay, I've got to prepare for my estate. I got to prepare, if I've just got a will and I'm leaving my stuff to my wife and I don't face the estate tax, I might not even worry about preparing a will and getting around to it. So it's very important to have signals that can catch people when they're making these major planning decisions. And I think so what's happened to the tax bill is actually worse than what I think we can estimate through our models, because I think it's sending all the wrong signals.
Jenny, you point out that the income tax doesn't do a very good job of taxing the capital income of high-income people or the wealth of high-income people. But estate lawyers say that the estate tax is essentially voluntary. And you kind of see that on that last chart where the share of wealth, that the taxation of wealth from the estate tax drops at the very, very highest income levels. So the estate tax is a backstop to the income tax, but it's a really lousy one. Should we try to fix the estate tax, or should we try to fix the income tax so it doesn't need a backstop? Or should we give up on taxing saving altogether?
I'm not going for the last one. I'd say a couple of things. There was a great book written about the labyrinth of capital gains, something or other. So one thing that I was a big fan of having the capital gains rate be the same as the income tax rate, simply because then people aren't spending a lot of their time and effort manipulating how their income is received. So I think in some sense, fixing the income tax, not necessarily to try to get at wealth, but just to try to get at less activity designed to escape taxation or to manipulate how you receive your income is a piece of it. But probably more importantly is thinking about what's going on in the estate tax. I mean, that was not a surprise, but kind of a wow, an eye-opener to see what happened for those very, very rich people. And what are they doing? I don't know if it's trusts, if it's variety of mechanisms. And so I think the first place I'd start, even as it's lousy, it's sort of like democracy is, like the worst system of government except for all the rest. So I think as a backstop and as a way to administer things, dealing with the estate tax and how we approach it is probably the best.
It's easy to do, right? We just adopt all the recommendations in that New York State Bar Association report from 20 years ago, which was totally ignored. Yeah.
That would be, yeah.
Yeah, good. Rob, the big problem with our study is, like all the other studies that have tried to figure out how the estate tax affects entrepreneurship, is that there's no question, are you an entrepreneur, or do you take risks and innovate? What can you speculate as to how, if we actually did have an entrepreneur variable on the Survey of Consumer Finances or HRS, can you speculate as to how that might change the results?
So you're right, we don't have any way of measuring innovation, and especially in surveys, and I'm not sure I believe the answer the question was actually asked. Mm-hmm. That said, it's difficult to know how entrepreneurs are behaving, but I can say that in our second part of our study, when we looked at how those who receive an inheritance react, we didn't just look at those who own and actively manage a business, we also looked at those who are self-employed. And we saw a similar signal, a similar result. It was smaller, but it was still statistically significant. So looking at this in several different ways from several different directions, and we're seeing similar kinds of results, gives us some assurance that we're at least in some part capturing the behavior of entrepreneurs.
Sounds like a great study. I should read it.
Can I mention something that I thought of, especially in Sheena's slides that relate? When she put up the slide that reflected the fact that the extent to which people give, the extent to which it's new wealth versus old wealth, and sort of the new entrepreneurs seem to be much more generous. I think partly because they're not used to living at a higher wealth status. They've gone through a transition there. And I think this is really interesting on the taxation of capital income issue, because if you're going to make differentiation, you might want to make the differentiation so that when you're accumulating the wealth, you have the lower tax, but for the inherited wealth, you actually raise the tax. So if we decide that we want to tax capital income at a certain level, and let's just say we've disagreed on that we're not fighting as liberals or conservatives over the extent we're going to tax capital, but now how are we going to tax capital? It seems to me it raises all sorts of interesting issues, whether there is a case to be made for some relief through deferral, which we often give, for taxes on the entrepreneur in exchange for a higher tax, say like capital gains at death, for the others, especially, and it would affect charitable giving because that might actually be positive on both fronts in terms of being able to get more giving from the entrepreneur, as well as not necessarily you're taxing more that group that's actually less charitable at the end of life.
Is it better for entrepreneurs to make giant charitable gifts, or should they more actively engage in philanthropy? And I'm thinking about, you mentioned Warren Buffett. I think several of you did. And he gave over $30 billion to the Gates Foundation, but he basically outsourced his philanthropy by saying, I'm good at making money, and Bill Gates and the Gates Foundation are really good at figuring out how to spread it around the world. Is that a good model? Should we be encouraging entrepreneurs to make big donations to existing organizations, or should we be encouraging them to try to find new things to do, which a lot of them are doing?
I think it's a good idea. I forget who said it earlier, that sometimes the entrepreneur wants to hold on to some of that and continue to manage their investments and all. And it allows them to keep that focus on the other interests that they have and not necessarily need to manage the philanthropy. It's a lot of work to make grants. Take it from a grant maker. It's really tough to do. And so the extent that you can use other instruments like community foundations or other philanthropies who want to manage it, it's not that he also gave over complete governance of the use of that. He's still very actively involved in setting the priorities of that giving. It's just the day-to-day management that he's turned over. And I think that might be smart and maybe a new way of helping more entrepreneurs to see a pathway toward philanthropy earlier so that they're not making that trade-off between stepping away from the business and moving into managing and running a foundation. Yeah. Others?
I was just going to say classic comparative advantage.
Okay.
Yeah, I was thinking the same thing. If somebody says they're bad at doing something, you don't want to necessarily encourage them to do more of it.
Oh boy. Okay. The tax cuts of 1981 actually set the stage, I think, for the Tax Reform Act of 1986, which Gene was very actively involved in, which actually brought me to Washington, I think Jenny too. When you're thinking about the Tax Reform Act of 2022, Gene, what would you do to rationalize our incentives for charitable giving and philanthropy?
So I think it's fair to say, and we saw it in this bill, that charitable giving is a tiny, tiny piece of how you design a tax. We don't collect taxes so we can encourage charitable giving, right? So you ideally want to do the normal things we say in doing tax reform, and I think they would work well for charity as well, which is you want to create equal justice means you want to tax people in equal circumstances equally. That usually means if you have about equal income, pay equal tax. Not always, there's some exceptions. It means you actually want to promote efficiency, you want to do a lot of other things. But in terms of charitable incentives, and I've written on this a lot in a number of places like the Chronicle Philanthropy, I think we can redesign them. So for instance, we could put a floor under charitable giving because the first dollars of giving aren't very, very important in exchange for a more universal deduction. I think that would be very positive. I've suggested allow people to give toward it up to the time they file their tax returns because I think the signal that you get right at the time you're filing your tax return is very powerful. You could get the money right back. I mean, grocery stores don't give you a coupon for the groceries you're going to buy 6 months from now. They give you the coupon the day you start going to walk in the store often, if not a couple of days before, and we could do the same thing with charitable giving. So I think we could, through a lot of incentive structures, increase giving. I think something like capital gains at death would actually encourage greater giving during life. People wouldn't think, well, I could defer ever paying tax on this income during life. So I think there are a number of things we could do to enhance charitable incentives without, by the way, necessarily raising or lowering the amount of money we spend in it. We could do a lot more efficiently in the charitable area. But I'll go back to my first comment. You don't design a tax code around the notion of how you're going to encourage charitable giving. It is a residual in a long set of priorities you have on how to design a tax system.
Before I throw this open to the floor, does anybody on the panel have any burning questions they wanted to ask their colleagues here?
I had one for Sheena. Social entrepreneurship, isn't that sort of a cloaking for saying, geez, I'm here in the community, and so I don't quite understand what that concept is, because you showed the different charts. I typically think of charitable giving or philanthropy as probably the one that's the top line. So Can you just say a little more about what social entrepreneurship means?
Yeah, and we'll learn a lot more about that in practice through a study that Elizabeth Boris and colleagues are doing to define the activities of that. But in general, it's having a business that also has a social purpose, and so that it is looking at what some people call the double or triple bottom line. And so it's not necessarily that they are giving those profits that are created from the business out to another charitable source, but the fact that they're creating more social value in addition to the business value that they're creating, they find that that is a philanthropic contribution, right? So it won't be distributed in the same way through contributions, but it's being created, and they might internalize it or invest it back into the organization, but it's still, they're doing better things, right? It's creating solutions for the homeless as a business rather than as a social service.
So is there a uniform way of measuring that?
Not yet.
Okay.
We'll get there, Elizabeth.
So Milton Friedman said that companies had an obligation to their shareholders, and they shouldn't engage in this kind of stuff. And that they wanted, if owners of companies wanted to do good things, they should make a lot of money and give it to charity.
That's right.
What's wrong with that?
But we're seeing even now in a lot of the divestment from NRA that the shareholders are encouraging the businesses to make money and do it in a way that they feel is ethical and connected to the reputation and the brand of the business. So even in more traditional business, we're seeing a lot more social obligation being put on that, and not so necessarily just now create a lot of money, put it into a foundation, and give it away as charity. So that's why I was making that big distinction between philanthropy and charity, because it really has a lot more strategic elements to philanthropy than our traditional charity.
Having an impact on this, Joe Cardis and I examined the extent to which our companies were changing their nature and individuals were changing their profession. So by anecdote, for instance, if I was to examine charitable giving a century ago, I might think of somebody working in a steel factory at the end of the day going off to the orphanage to work.
You're
But
not
today
that old,
you have,
Gene.
huh?
You're not that old.
But today you might think of almost anybody in this room, the skills you have as a professional in this room apply in both fields. You can apply, if I'm good at advertising, I'm good at computers, whatever it is. Often my skills apply just as equally in a charitable area as a non-charitable area. And if you actually look at what the employment of people, more and more they are employed in companies that could be defined either as charities or non-charities. So think of the biggest growth sectors of the economy. It's in things that use information, education, computers, healthcare. So you have this mix where the society is becoming more and more doing things that could be defined normally as charitable or as business. And so I think that part of what's going on in the economy puts this pressure on people wanting to be social entrepreneurs. They say, well, I'm an undivided self. How do I can't just do my charity work at night and my non-charity work during the day.
Mm-hmm.
I want to throw this open for questions from the floor. I guess we must have been really, really clear. There is a microphone. Oh. Yes, please. And identify yourself, please.
My name is Michael Barris. I'm actually a financial advisor and former tax lawyer. And one of the things that in a lot of the data sets didn't seem to come up was the impact of advisors. So, do advisors have an impact on when people are giving, how they're giving, whether or not to give? Because, simply stated, as a financial advisor, if I tell people to give away their money, I'm not managing it anymore. Not that I don't, but that may have an influence on a lot of the people you're talking about.
Do a lot of people ask you about how to arrange their charitable giving or philanthropy?
Very few. It is a surprisingly low percentage of people that I work with that give away a meaningful percentage of their assets, either during their lifetime or at death, and it is something that I often am discussing with them, both because I was a tax lawyer and there are tax opportunities, but also because I serve on a couple of nonprofit boards myself and think it's an important thing to do. But it doesn't often get a resounding, oh yeah, let's do that. It's an area that I find most people aren't interested in, and most advisors are not prepared to educate their clients on.
Do you think that's because so that it is really puzzling for economists that there are a lot of ways to avoid tax, mostly involving giving during life. First of all, there's the $13,000 a year or $14,000 a year exemption for donations or transfers to others. It's completely tax-free. Then if you make a gift that is subject to the unified estate and gift tax, you get an income tax deduction, and it reduces the value of your taxable estate. So you basically get a double deduction. You obviously understand this. Do you think your colleagues understand it and share it with their clients?
Well, those are both, those aren't really charitable donations you were just talking about. Those are individual transfers to family members, which surprisingly, when I've gone back to clients and said, look, you're going to have a taxable estate, why don't you start giving to your kids? I've gotten pushback from their lawyers saying, but the kids will just blow the money. And I've had lawyers that have been sort of really strongly discouraging it to the point where they said, put it in an irrevocable trust so the kids can't actually get it. And I'm thinking, these kids are going to end up with tens of millions of dollars. You probably should let them blow the 15 or 20 that they're going to get so they can figure out how to blow money and understand the disadvantage of doing that. So the structure is not there. Lawyers don't do it well. I don't think financial planners do it well, but I think there's a real need for them to understand the value of that. So I found one client who was the recipient of a major gift from a parent because they were taking advantage of the ability to transfer assets during their lifetime, but no one other than that in 25 years of doing this.
Sheena?
Yeah, that's really interesting. I'll just add that the point you make, it's not trivial that, especially for the advisor, when they give that money away to the charitable giving, then they're not managing that money. And we've seen that bear out now in new data around impact investing, and that becoming a more palatable vehicle for financial advisors. And they're becoming much more educated around it because they still are managing the money and having some sort of philanthropic good created through that. And that seemed to have a lot more quicker take up than the just give it away to charitable giving. Yeah.
In the community foundation that I'm heavily engaged in, we have an advantage over the individual charities because we're basically trying to raise money for all the charities, at least in our community. And so we actually attempt to get the financial advisors together as a group. That's actually a major effort of a lot of community foundations. But we face exactly the issue that you're talking about for some financial advisors. This works against their own self-interest, right? Because they're going to have less money to manage, less money to charge. That's also an issue in small foundations, which are very inefficient, not converting to donor-advised funds. Why should they be paying out all this money to manage a small foundation and losing perhaps all of the return? There are ways we try to get around it. Among them is most community foundations now offer, for people who put money in donor-advised funds, the option of letting the capital income within that donor-advised fund to be defined as a charity but still managed by whoever it is, Merrill or T. Rowe Price or whoever else it is, or you, as one option. But even then, you might say, well, if you give away your money sooner, then there's less to be earned. So that is an issue. That is an issue. But I think that reflects also this notion that I say that I don't think as a society we've really figured out well how to ask people to give out of their wealth, to really think about it.
Yeah. Do you remember seeing any data on financial advisors in the SCF? I don't think I've ever seen it. But it'd be kind of interesting to see whether people who say they have a financial advisor behave systematically differently. Although that wouldn't prove the financial advisor caused it. It could just be a correlation. But
to the extent you're looking at the itemized deductions, you might be able to tell if someone has a financial advisor, because it is in the schedule, on Schedule A. At least it has been. It won't be anymore. But it's on Schedule A. The financial advisor fees are tax deductible, so you might be able to tell if somebody's got an advisor.
That's a good point.
Yeah, I don't know if anyone's looked at that before.
Other questions? Yes.
Hi there. Sheena, I know in your presentation you had a map just regionally where entrepreneurs are likely to be. I suspect that's maybe for brick and mortar businesses. Is there any data for online entrepreneurs?
Yeah, that captures all of it. So the online entrepreneurs, the folks who are also doing more self-employment through the gig economy, that's picking up all of that activity. And that's why we're seeing this sort of shift toward the middle and not the coast. When it's focused mostly on technology companies, there's still a coastal bias with some moving out into mid-sized cities. But when we take into consideration that whole picture, gig economy, brick and mortar, technology companies, you see a bigger spread across the Midwest. And it's pretty good, right? I mean, especially when you're doing technology companies, you don't need to necessarily be where your customers are.
Right.
And so entrepreneurs are starting to move to lower cost areas like Kansas City, where they can have a good quality of life and also build their business online.
I see. Thank you.
Yeah.
Eric.
Eric Toto, Tax Policy Center. I have a question for Sheena. I was interested in your comment about how entrepreneurs tend to give more than people with inherited wealth. But I was kind of wondering, there's a lot of money being made by entrepreneurs, and young people will be giving away a lot in the coming years. And that's basically supported by public funds. Do we have any evidence on how that pattern of giving compares with how public spending is generally for domestic purposes, and whether we're comfortable about having so much of the country's resources allocated by wealthy individuals rather than some democratic process?
Oh, you get to the heart of the matter, Eric. This is a big issue, right? Whether or not the role of philanthropy is to complement, substitute, or be something very different from public good. And what we do in studying sort of the patterns of giving, out of private giving, and the patterns of public giving, is we do see the giving going to similar subject areas and to similar organizations. So the way that government behaves when it's giving grants is very similar to the way the philanthropist gives in its grant making. And largely, that's not because we can observe the preferences of government or the philanthropists very well, but we see the successful competition of the larger organizations and the nonprofits who are there. It's more an effect of the fact that we do this through fundraising and grant writing and competitive activities that allow people with more resources in their fundraising to win it. And they're winning it from the private philanthropist as well as from the public grant maker. And so we don't see much of a distinction into who's winning and where the money is being allocated. But there is a growing sense, though, that the way in which the philanthropist gives is a little bit more efficient than government providing it. And government has a particular interest in allowing there to be more community determination of who is supported and where the needs are. So there is some real democratic advantage toward charitable giving being a way that a lot of the social goods are met and funded, but we can't do it at the scale that government can. And so we tend to think of private philanthropy being an indicator of where the public will is, and then hopefully government will step in once they see the voice of the people through their charitable giving. But there is always concern about the fact that we give in the same way that we do club goods, that we're giving to our own communities, and it's not very fairly or efficiently or equitably allocated at all. So very much concerned about that.
Government support's about 10 times larger than individual giving, so the question is usually posed the opposite way. Not that the wealthy are dominating where the money's going, but the government is.
Yeah.
So Jenny, you actually mentioned Thomas Piketty as some motivation for your work. And some people have proposed an annual wealth tax, or at least a periodic wealth tax, rather than just a tax at death, and one that's relatively easy to avoid. Is that a good idea? Is it practical? Have you thought about that?
I don't think it's practical.
Aside from that, what's wrong with the idea?
Um, I'll stop there.
Because of the problems of measuring wealth on an annual basis.
Well, and then just fluctuations over the years and people having to come up with the means to pay, and then it seems like an administrative nightmare.
What about trying to move the income tax to something more like a tax on economic income? In Netherlands, they tax imputed income on a lot of, basically instead of taxing capital gains when you sell assets, they impute a rate of return and you pay that tax every year. Eric Toder's proposed, Eric Toder and Alan Viard proposed taxing capital gains on an accrual basis, actually as a way of integrating the corporate and individual income taxes. So that kind of moves in the direction of not a wealth tax, but a tax on
Right.
what economists would call income, what you call income. Is that a good idea? Should we be moving in that direction?
I liked Eric's idea in thinking about, I just did my own taxes, and in thinking about years when you have gains, losses, and being able to plan and budget as an individual, I think that would be tough. So,
Any other questions? Well, we are about out of time. I want to thank, do you? The slides?
Sure.
Are you okay with sharing the slides? We'll post them on the website.
They're online. They're
What?
online.
Oh, they're on already. Okay. I want to thank our events team for their hard work in putting this all together, especially Ann Clevin and Yvonne Powers and the rest of the team. And thank all of you for coming, and thank the fantastic panel.
Thank you.